Have you ever asked yourself, should I pay off my mortgage or invest the dollars? This is a really common question that we get. People are always thinking, I don't know whether I should work on paying off my mortgage or putting money in my 401k and my investments. Well, what we're going to do today is we're going to mathematically solve this question. Should you pay your mortgage off or should you invest the money? And we're going to throw in an additional thing, how you can do both at the exact same time. Let's dive in. So I know this is a common question that gets asked because we hear it a lot. Should I pay my mortgage off or should I invest? In the last 10 years, I'm going to tell you the answer. Most people think they should invest. They choose investments because they're like, well, I got a really low mortgage payment. My mortgage is only 3-4%, and I can earn way more than 3-4% in the stock market. So before I get into why you're wrong in thinking that, let's just go into the math. So what I did is I looked up a couple things and I thought this would be helpful. The first thing I looked up is right over here, the historical performance of the S&P 500. Now I could do any stock market, I could look at all of them, but the S&P 500 is the one that most people do. So if we want to look at that, the thing that you would look at right here is you would look at compound annual growth. So since February 92 to June of 2024, the S&P 500 has basically averaged 10.46%. That's not too bad, right? So right off the bat, if you're looking at it and you're saying, well, the stock market's done 10.46 and my mortgage is only 4%, which one would you choose? Of course you would say 10.46. Of course you would, because it's way more than 4. And some of you are like, man, I don't have a 4, I got a 2.8. But you get what I'm trying to say. So you're making literally 6.46% more by investing in the S&P 500. Wrong. You are absolutely wrong in thinking that, because that isn't the way your mortgage works. You see, they've tricked us all. The banks are so smart. The banks have literally got you to literally drink from the proverbial bank nipple. I don't know if that's the right way to say that, but we're going to go with it. Because they have led you to believe that just the interest rate and the interest rate alone matters the most. But it's not the interest rate in your mortgage, folks. It is the volume of interest you're paying. It makes no difference what your interest rate is. The volume that you pay is what matters. And I'm going to show you that. So right here, let's just switch screens and let's look at this. All I did is I just mocked up a mortgage. I went to bankrate.com, you can see it right up there, and I went to mortgage calculator. And I just put in, I just let it do what its thing. $425,000 mortgage, $85,000, 20% down, 30 years, 6.979. But now hold on a second. Let's come over here and let's do something fun. Let's make that 4. Now, before I do that, I want you to hyper focus on this. You see, the interest rate makes a massive difference in your payment, not the volume of interest. And that's what I'm going to prove. And then we're going to compare that stock market return with your mortgage, and then you can decide which one's best, and then I'll give you a third option. So $26.03 per month at that 6% range that we just did. But if we change that to 4, look at that. Now you're only at $19.69. So why did so many people rush out to refinance their houses when interest rates were dropped extremely low, almost to zero during the pandemic? That's the reason. Your payment was reduced, and I'm not going to disagree. That's a huge deal for most American families. But the one thing that you fail to look at is the volume of interest. And it's very easy. So if I can just show you how we're going to do the math, all you need is your phone. So grab your cell phone, pull up your calculator, and then what we're going to do is we're literally going to come over here and we're going to look. Now, we all know this because we've done the math. You look at my loan amount was $425 was the house price minus the deposit, $340,000, and over 30 years you're going to pay $244,000 in interest. But that's not even the big deal. When you pay the interest is what really matters. You see, mortgages are really front-loaded, meaning the bank controls the volume of interest you pay. They want to get paid all their interest up front. Hence, why is it that when you take a mortgage out, most of the time your mortgage is sold to another bank, another servicing company? You think that's just coincidence? It's because the most profit in the mortgage is in the first 7 years. Why 7 years? Let me just hit that real quick. Banks are so smart. I say this all the time, hence why you should just mimic what a bank does and be your own bank. Shameless plug. Banks are so smart that they have done studies to figure out that you, me, and everybody else average a new house every 7 years. But even if you don't move into a new house, you refinance every 7 years. Why 7 years? Well, it's a cycle. It's the short-term debt cycle. It's every 5 to 7 years. You see how this is all coming together? Ray Dalio teaches the short-term debt cycle perfectly well. So let's talk about that cycle. You can go from, like back during the pandemic, a low interest rate cycle, and then it's going to go up to a high interest rate cycle, and then in another 5 to 7 years, it'll be another low interest rate cycle. It ties right in with recessionary periods as well. So that is what banks know. They know you're going to refinance or move every 5 to 7 years. Therefore, they say, let's front load all the interest in the first 5 to 7 years of your mortgage so we get paid all of our interest up front. Freaking brilliant, right? Well, let's just look at the math on that. Let me scroll down here a little bit. We're going to look at an amortization schedule. And all I want you to do is I really want you to pay attention to one thing. And that one thing I want you to pay attention to is right here. Here's your principal, here's your interest in 2024. Which one's greater? Okay? Which one's greater? Is it the 2465 or is it the 5650? The 5650. But then let's just come down here and let's just look at the first mortgage payment if you were to do this, would be in August. That total mortgage payment, $489 went to your principal to reduce the principal, and $1,133 went to interest. So here's where we just got to do a little bit of math. We already know that low interest rate resulted in a lower monthly payment, but it almost makes no difference in how much interest you pay to the bank in a percentage standpoint. So let's just do that. So if your mortgage, and I'm just going to write it right over here, if your mortgage was $1969 a month, okay? So let's just do the math. $1969 a month. Here we go. 1969 times 12. That means every year you're going to pay $23,628 total. That's your total annualized mortgage payment. But if we just go back to monthly and we look over here to, let's just do September, $491.51 and $1,131.70. So let's do that, okay? So now here's how you do this. Take the interest right here, $1,131.70. Just trying to make this super simple. See how I did that? Okay, that's all you do. Now what I want you to do is I want you to hit divide that into your total monthly payment, because what we're trying to figure out is how much interest is the bank charging you per month. How much are you giving up in interest? Well, it's a simple thing right there, 57.4%. Everybody understands how I did that, right? 57.4. So every monthly payment you are making on your mortgage, you are giving up 57.4% to interest. How many of you want to make 57.4% versus, what was the stock market return? A bit over 10%? You want to make a bit over 10, or do you want to make 57? But some of you are like, yeah, Chris, that's only the first year. Well, hold on, okay. Let's go a couple years later. 2027. Here we go. 2027, down here. Here's your interest. Is it really that much different than the numbers that we used here? Look at that. Nope. But let's just do the math anyway. So you go down to 2027. You can see you are still giving up a huge percentage. So there's the interest you're paying, okay? $1,083.70. Now remember, you go to divide and just divide it into the mortgage payment. 55. Whoa. 55%. Several years later, you have hardly changed the velocity of interest you're giving to the bank. So you see, I get that you think that you are saving money because you're low monthly payment, but you're only saving the monthly payment. You are still giving away a huge percentage of every monthly payment to the bank. That's called velocity of interest that you're losing. So when you do all this, and we just do the math, so here's an easy way to do this. So let me clear the screen up a little bit now that you understand. So now what we've got to do, since we know that the stock market, the S&P 500, has averaged a little over 10%, let's look at that mortgage. Because remember, the mortgage that you probably have is way less than that stock market return, right? Well, that's what we're going to talk about. Because it's not the return versus the mortgage interest rate. It's the volume of interest that you're giving up on every single mortgage payment you make. You see, the banks are so smart. The banks have found a way to get paid all the interest in the early years. Absolutely. They have figured it out. And I'm going to show you how banks have literally tricked us to drinking from the proverbial interest titty, I guess you would say. I don't know the right way to say that, but let's just go with that. So that you're giving them all the interest up front while you think that you're winning because you got a lower payment. So what do I mean by lower payment? Well, let's just look at a hypothetical example. You buy a house for $425,000, you put 20% down over, it's a 30-year mortgage at 4%. $1,623. Now, people are always saying, well, my payment's so low. Right, because if you were to go to today's interest rates, let's just call that 7%, your payment would be $2,262 per month. But you more than likely probably have a mortgage that's 4% or lower, so it's $1,623. That's the amount. Now, that's great, but that doesn't mean you're winning. Your payment's just lower. It's not the payment or the interest rate that you should be really calculating in this kind of a scenario. It's the volume of interest you're giving up. So let me prove that. And all we're going to do is we're just going to go up here to the amortization schedule. Now, when we come here, you can already see that you have given $244,356 in interest paid on a $340,000 loan. So let's just quickly do the math on that. So if we do 244,356, the total interest, remember this is just the interest paid, and we divide that into the total loan amount, 340. Now all of you should think that that should just be 4%, right? How about 71? How about 71.86%? So the total cost of your loan wasn't 340, it was 340 plus all the interest, which works out to be 71.86%. Now, do I have your attention? 71's a pretty darn good return, right? Well, let's look at how that number works. 4% is the rate we're looking at. But now we got to go into what's called an amortization schedule, and we're just going to come down here. So if you took a mortgage out, for this particular mortgage, in August, that would be your first payment. That first payment, which remember was $1,623. $1,623 a month. That's how much money your monthly mortgage payment is. So I'll just write mortgage payment. Okay, there we go. Now, how was that $1,623 allocated by the bank? Well, it's simple. $489.88 went to your principal, and the interest was $1,133. So let's just do the interest. Now here's how you do the math, folks. This is really simple. What we're going to do is you're just going to take $1,133.33. Okay, we're going to take that. That's the interest per month you're paying. And all we're going to do is we're going to hit divide that into the $1,623, your monthly mortgage payment, your total monthly mortgage payment, right there. Can you guys see that number? Well, if you can't, I'm just going to write this in here. You are paying 69.82%. That is the amount of every single payment that is going toward interest. So real quickly, let's just go back and do some math. Now, if we all remember when we looked at the S&P 500, the S&P 500 was 10.46%. So let's come back over here to the mortgage, 10.46%. So let's subtract that, 0.46%. Which one would you prefer? Do you want to make 69.82% on your money, or do you want to make 10.46% with risk? Are you starting to see what I'm explaining to you? The return that the stock market is making you is nothing compared to the velocity of interest you are paying to the banks. You are giving this money up because you were tricked into thinking that it was the interest rate, the 4% that's carved in your mind, or whatever your mortgage payment is. You were thinking that's the almighty. That just helps you get a lower monthly payment. It doesn't help you take back the interest you're giving away, 69%. Now listen, a lot of people, when they would see this, they would say, yeah, but that's just because it's the first year. Great, let's go 7 years into the future. Okay, so 1, 2, 3, 4, 5, 6, 7. Let's just go 2030. 2030. Now you would think that the numbers have to be way better than 69.82. Well, let's go right here. Let's go April of 2030. Roughly 7 years out. Now 7 years is a key number, and I'm going to explain that. I'm going to explain why 7 years is critical. So let's just do the math. Now, same thing, $1,008.93 divided into your monthly payment, $1,623, equals 62%. Not really making a lot of headway. You still want 62% versus the 10? Well, Chris, you must be thinking to yourself, where does this thing break even? Well, I don't know, maybe down here, right around the time when you no longer own the house anymore. Now look at here, 2050. That's all we had to do. We had to go to 2050. Now you're only paying, let's see if this works out, $271.49 divided into 1623, 16% still. Wow. You're still giving up 16% of every payment to interest. Folks, that's 2050. Do the math. Do you see how this works? Now here's the thing I do know. Almost every single one of you watching this video, you will not live in the same house you're in today in 2050. You probably won't even live in the same house in 2040. You know why I know this? Statistics. You see, banks are really smart with these statistics as well. Banks know that every 5 to 7 years, because of the short-term debt cycle, study Ray Dalio if you want to learn about this, the short-term debt cycle says that you will have a high and a low period, a cycle in interest rates every 5 to 7 years. So why would the bank want to front load all the interest in 5 to 7 years? 2 reasons. Number one, they know that in 5 to 7 years, you're probably going to upgrade or go to another house, especially in a cycle like right now where we're at high interest rates and we're likely to go to lower interest rates in a 5 to 7 year period, right? You would refinance your house or you would buy a new house when rates were lower than they are today. Fact. But the other reason I know this to be true is not just because you'll buy a new house. When rates go lower, if you were to mortgage a house today at 7%, if rates went down to 3%, would you not refinance your house? You would. So what does the bank get every time you buy a new house or you refinance your house? What do they get? More closing costs, more fees, and they get to hit the restart button on that awesome machine that allows them to get 69.82% of every one of your mortgage payments in interest, in profit to the bank. So in conclusion, with this whole thing, it doesn't matter how we run the math. Your 4% mortgage or whatever it is isn't really 4%. That's great for calculating your monthly payment, but you're losing to the volume of interest. So back to the original question, should I pay off my mortgage or should I invest? You can make your own decision. You should do both, but I would definitely say if you had to choose and you had the means to pay your mortgage off, focus on that. So here's the thing. If you did focus on paying your mortgage down because you're sick of giving up the velocity of interest to the bank at those kind of massive numbers, and those are factual numbers, we just did the math. Here's the other plus. As you pay your principal down, okay, what that means, because you're gonna make extra principal payments, you are gonna build more equity. Unless your house loses value, this equity could then be converted into a HELOC. And if interest rates were to go down from where they're at now, the HELOC would get cheaper and cheaper. So let's just say you can get a HELOC between 3 and 8%. Remember we said the S&P 500 made 10 over that period of time. So you could create the equity by paying the principal down of your mortgage, re-access all of that equity in your house through a home equity line of credit, and then redeploy into whatever investment you're looking to go into. You follow what I'm saying? So it's not this or that, it's this and that. you can pay your mortgage off, take back the velocity of interest you're giving away, and then get a HELOC, and then invest the money any way you see fit. You see, I teach this every single day, but I do this using the infinite banking concepts, and especially designed and engineered whole life. So what we would normally do in a scenario like this where somebody wanted to pay their mortgage off is we would change where the money goes first. We would put it into the specially designed and engineered whole life policy. Then we would take loans from the whole life to pay the mortgage down, because then every dollar that's in that whole life is earning interest and dividends, compounding for the rest of your life while you still achieve the same results. We can mathematically show this to you. So if it's something you're interested in, right in the bio, just click the link to the video, schedule a call, and we can walk you through all these different scenarios. But no matter what, I think now you can make an educated mathematical decision as to whether or not you should pay your mortgage down or off, or invest in your 401k or investments. It should be both, but if you can only choose one, I think you know which one makes the most sense. Folks, if you like this, check this video out right here on how I am paying my mortgage off, and you can get some pointers from that. See you on the next one.